Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall, tradinganalysis.com. Appreciate you guys taking time out of your Wednesday mornings to join us. Hope you guys are doing well. Wednesday the 23rd. We are approaching March already. The year has gone by very quickly. Coming up against the March Fed meeting, I think that's the next biggest event for markets, other than, of course, the geopolitical tensions overseas with Russia and Ukraine. A lot going on, a lot of uncertainties. Yesterday was a really key day for the markets. The indexes pushing lower, challenging that zone of support in the bullish count, potentially leaning in the direction of the alternate X wave that we discussed. We'll get to the charts in just a moment. Before we get to the charts, let's go ahead and bring in the trading analysis team. We are short this morning, one team member. However, we'll be sure to hit gold. We'll also take a look at crude oil. Good morning, Terry. How are you today, sir?
Good morning, B.
Welcome back.
Hello, guys. How's everybody doing today?
Yeah, good morning, Johnny. Good morning, Lisa. Good morning, Carl. Glad to have you guys on board the stream. So what's new?
Yeah,
what's
we're
new?
missing Alex today. I saw him texting at 1:40 a.m. this morning. I wasn't up at 1:40 in the morning. I just looked over at the Discord. That guy never sleeps. He's constantly on helping out the members on crypto day or night, believe it or not. And he's over in Serbia, right? So it's 8 hours.
Cryptocurrency
ahead of us.
Right, and I was going to say cryptocurrency. It's kind of like New York. It's the market that never sleeps. So he's up at all hours.
Crypto never sleeps. It never takes a holiday. 7 days a week, 24/7. So,
ain't that the truth?
So anyway, Alex will be back tomorrow, guys, with his crypto lab, right? So don't miss out on that. But we do miss Alex's macro perspective here. So Bennett and I will try to cover all that for you.
Yeah, certainly. Good morning, Phil. Good morning, Oleg. And of course, as Terry mentioned, he will be live tomorrow morning, 9 a.m. right here on the TA Live YouTube channel. Taking a look at cryptocurrency, of course, with the volatility. Very curious to see where that ultimately goes. I'm still not discounting the flat in Bitcoin. I still think there's a possibility that's the case. So we'll see what Alex has to say. So you staying warm this morning? I asked the...
I am. It looks like you got some cold weather hitting your area, Texas.
Yeah, it was mid 30s, and that's going to be the high of the day. So that's always a good time. It's a chilly live stream today. Chilly live stream.
I'm closer to the coast in East Texas, so I don't think we're going to get quite that cold not until this weekend. But I think all this cold weather, I was looking at the weather forecast, is going to blow all the way up north into New York, and Todd's going to get it. He's going to get hit pretty hard Friday with some heavy snows in upstate New York. So, yeah, everybody up in New England, get ready for it again. Here it comes. Punxsutawney Phil was right. 6 more weeks of winter, and it's still coming. So,
yeah, that's the truth. That's the truth. It's been quite the interesting winter season. But hey, he'll make use of that snow. He always likes to get out there and shred the fresh powder. So, hey, let's jump into it. We're going to take you guys through the charts. I will touch on gold as well as crude oil, given the fact that Alex is out. We'll take a look at yields and bonds as well, given the move that we've seen recently in the 10-year. Take a look at the indexes, and then we'll jump into Optima with Terry. Sound good?
Very good, very good.
All right, I'll see you on the other side. Catch you in a few minutes, Terry. All right, good morning once again. We do appreciate you guys taking time out of your mornings to join us. If you caught the presentation I did yesterday, I presented as a guest at an Elliott Wave workshop. And I tell you what, given the market volatility and the multiple possibilities that we're looking at from an Elliott Wave perspective, sometimes it's difficult to come away from an event like that feeling like you communicated the analysis effectively. We are up against a challenging situation here in the indexes. We'll take a look at the key levels, the decision points that we need to be aware of as we head into today's session. So before we do that, let's talk a little bit about what's been at work in gold. First of all, we have been tracking the makings of what we view to be a wave 4 consolidation. This wave 4 consolidation started back in August of 2020. And if you'll notice here, we have a base trend channel. This base trend channel is not a channeling technique that is specific to Elliott. We know there are two specific Elliott channeling techniques that we've talked about before, but this is just simply a base channel. We're taking the 2015 low, we're drawing a trend line from there through the lows of August 2018. From there, you project your parallel trend line over the 2016 high. So essentially, coming out of this 5-wave rally and back here in the wave 2 position, you could have had this base channel established. And this base channel, as you'll notice going up into 2019, did offer resistance. You can see a rejection at the upper boundaries of this channel. We then consolidate, we set a higher low, we break above, consolidate once again, and now as we move back into a retest of this particular base trend channel, you'll notice that back in March of 21, it started to offer support. And from the low in March of 21, we've been seeing a period of higher lows and lower highs. This is typical of a triangulation, Elliott Wave triangle. And last week, given the move higher in gold, we looked at the possibilities. Alex presented the view that would perhaps extend the triangle. This would allow for essentially a triangle within a triangle, in that the D wave position of the intermediate degree has a triangle within its B wave subdivision. So wave D here is still a 3-wave subdivision, as a triangle should be, but it actually has potentially a triangle here in the B wave position. The issue now becomes the break above 1916.20. The 1916.20 high took place back in June of 21. That's a key level for gold that, if we were to exceed and continue above, would suggest that this wave 4 triangle actually completed back into the December 15, 2021 lows, so from last year, and we're now seeing the initial impulsive structure post-triangle thrust. So let's get off of the daily, and I'm going to take you down to a 195-minute view. We're going to adjust our bars here. Looking at the idea that wave D of the triangle finished November and wave E of the triangle finished in December, we can then track the makings of a potentially impulsive trend. This is a mode of 5-wave structure that would essentially confirm the breakout from consolidation for gold. What we have here, and the way I'm labeling it personally, is a 5-wave rally in orange wave 1. We have a wave 2 flat. The wave 2 flat ultimately finds support at the 61% retracement, so that's appropriate. It's a bit of an unusual subdivision, but I want you to notice we do have 3 waves higher here in B. Could you call this 1, 2, 3, 4, 5 of an expanding leading diagonal? Let's find out. I believe wave 3 in this instance would be shorter than wave 1, just visually looking at it, and that would not be appropriate. And then also the wave 4 would exceed the wave 2 low. Regardless, the implications are very similar, and that is a wave 3 break from the wave 2 low back on January 28th. Looking at the wave 3 zone of resistance, we do have a 200% 3v1 relationship at 1900 spot 5 that was exceeded. If we look inside the subdivision of orange wave number 3, we do see the makings of a 5-wave structure. If we look at the fib associated with that subdivision, we'll see a move potentially up here to 1912 spot 10, and we could technically meet the 2618 at 1939.70. More importantly, regardless of where this third wave finds resistance, the next move that I'll be looking for to begin to confirm the breakout from consolidation for gold will be the wave 4. This wave 4 would pair up to this wave 2 flat that finished back on the 28th. And given the guideline of alternation, it's possible we actually see a more directional wave 4 correction, given the fact that wave 2 in this instance was sideways and a flat. From there, and I want you to notice this 1916.20 level, which was the the B wave high of the triangle, which we need to exceed and close above to confirm the triangle is finished. That particular level is more or less in the middle of this fib cluster, this upside third wave fib resistance cluster. So I do think this zone of resistance can offer us a corrective retracement. That's going to be sign 1 that the triangle is over. Sign number 2 will be a completion of that 4th wave move, and then a break higher in the wave 5 position. The depth and duration of wave 4 is unknown at this point. We're looking for something more or less similar to wave 2. If it alternates, it's probably going to be shorter in time. And once this 5th wave sets in, if in fact we do get it, we will then be met with a larger wave 2 correction. That wave 2 correction will retrace the entirety of this initial 5-wave breakout from triangulation. And that 3-wave structure, I feel, will be the true opportunity zone for gold if in fact we are going to get wave 3 continuation. So that's our view right now on gold. Let me take you over to crude oil. I put out a chart of crude oil on our YouTube, a public YouTube update. We've been tracking a very key trend line break, a break above a key trend line, which was about a 10-year downtrend resistance zone. It turned into support. We noted that back in December, and we have seen the upside continuation in a 5-wave structure. We do see resistance between 97.5 and 99.5. We technically, when looking at the subdivision of this particular orange 3rd wave, we technically have the minimum requirements met to suggest that this 3rd wave is over in the form of a wave 5 expanding variety diagonal. Being expanding, 3 needs to be greater than 1, 5 needs to be greater than 3. In this case, wave 5 technically exceeded the magnitude of wave 3 when we broke above 95.51 back on the 14th. Until we break under 88.51, however, this can actually still be an ongoing diagonal. Whether this is A, B, and C of wave 5, because remember, ending diagonals, the 1, 3, and 5 positions need to have 3-wave subdivisions. So until we break south of 88.51, this could still be an ongoing wave 5 of 3 up to maybe 99.5. Once that resistance is met, we're going to look for a wave 4 to pair up to the wave 2. Then we'll see a break higher in wave 5. That'll probably take us somewhere into $100 a barrel, perhaps, looking at the fib levels. And once that completes, it's going to be kind of similar to what we talked about in gold. We're going to need to really track the characteristics of price action to determine if, in fact, this was just a big 5-wave rally from the March-April 2020 lows, or if the more bullish 1-2-1-2 possibility is at work. And we talked about this in that public update. Be sure to check it out if you are interested. All right, so that's gold and crude oil. Let's jump over to the U.S. indexes. Switching to the other instance of motive wave here, we're going to first talk about where the markets have come, because in order to look where markets might be going from here, we have to have an understanding as to where they've come from the credit crisis lows back in 2009. So March of 2009, you'll notice the S&P had completed a big sideways flat correction. You have a move down in A, a move back in B to the highs, there's the fake out move, and then a nice motive 5-wave structure down in wave C. Wave C, March of 2009, did exceed the September 2002 low. So you could not source this as a 1-2 and suggest we're in a wave 3 pairing up to this right here. So looking at the trend, independent of everything that's happened previously for the S&P, looking specifically at the trend change from the 2009 low, you'll notice we have evidence of our initial 5-wave structure. So here's the first 5-wave trend establishing move out of the flat. That move is, guess what? Met with a flat correction. We have a 3-wave move down in A, 1, 2, 3, 4, 5, 6, 7 major price swings in B, which is typical of a 3-wave subdivision, and then 1, 2, 3, 4, 5 waves down in C. Wave C completes, finishes the wave 2, and then we break higher in the wave 3 position. When looking at wave 3 objectives, our first wave 3 objective is, of course, equality to wave 1, meaning if you were to take a Fibonacci measurement of this rally, project it from the wave 2 completion, that's your first upside target in a 3rd wave move. You'll notice we meet resistance there, enter a period of consolidation, but then proceed to break higher. The next and more common wave 3 objective is a 1-6-1-8 relationship to wave 1. That came in at 28.55. That's where markets met their September 2018 29.41.91 intraday high. I don't think I'll ever forget that number. And then we proceed to enter wave 4. So thus far, the evidence suggests that the COVID low was a wave 4 flat pairing up to the wave 2 flat back in 2011. Interestingly enough, one of the fib relationships at work here, which suggest this is wave 4 pairing up to this wave 2, is the guideline of equality. The guideline of equality suggests corrections of the same degree tend towards equality in magnitude or duration, sometimes both, typically not both. In this instance, believe it or not, the 2010 through September 2011 wave 2 correction was echoed in that wave 4 completed about a month beyond what would be equality. You can see that 4v2 100% reading there. So we have 5 up, 3 wave correction, 5 waves up, 3 wave flat. This third wave has a beautiful 5 wave subdivision of its own. Wave 4 is a 38% retracement. And I want you to notice this level. When looking at a wave 5 target, you have to first analyze 1 and 3. And in this instance, we do have an extended third wave. This particular third wave of the orange primary degree met about a 1618 projection of 1. Very standard. When looking at wave 5 with the extended third wave, our first objective is equality of 5 and 1. That's a guideline Elliott offers. And you'll notice 5v1 equality did offer resistance in March of 2017. We consolidate, and then we start to really break out in August of 17. The next most common wave 5 objective is a 61% relationship to waves 1 and 3. Said otherwise, if you were to measure the magnitude of wave 1 and 3, so essentially measuring from the wave 2 low through the wave 3 high, projecting it from the wave 4 low for those of you who don't have motive wave, and looking at that 61% relationship, that's your next most common fifth wave target. So all of this tells us that from the COVID low, we have been likely trading in cycle degree wave 5, which means from a technical perspective, there is the possibility of a larger bear market. I think if you look in the financial media, you see a lot of mixed opinions right now, and there's still a lot on the table. We need to see how the Fed's going to react. We had the January CPI data. When January CPI data came out, markets immediately started to price in a very hawkish Fed. And if you look at the CME Group's probabilities of a rate hike into the March meeting, we went from pricing in a quarter-point move to pricing in a half-a-point move. Markets have tempered those expectations. And at this point, it does look like they may be on hold until we get into that Fed meeting. Now, the discussion we just had in Orange Wave 5 of Green Wave 3 is the exact same discussion we're going to have for the cycle degree Wave 5. I think we can all agree Green Wave 3 was extended. You have a 5-wave subdivision, and you meet the 1618 relationship to 1. So let's look at our Wave 5 targets. Well, our first Wave 5 target was, of course, equality to Wave 1. 5v1 equality in the S&P came in at 4,009.70. And zooming in here, you can see that 5v1 equality was met back in March of 21. We paused there briefly, and now we see continuation. If we look at the next most common Wave 5 objective, the 61% relationship of Wave 5 compared to 1 and 3, we'll see that's up at 54.84.15, which means we could still have a sizable upside move left in the indexes. So now we've got to break down Orange Wave 5 and ask ourselves where the heck we are in the Orange Wave 5. Do we have a completed 5-wave move into January 4th of this year, thus setting us up for, one, a retrace of the breakout post-COVID low, or worst case scenario, this turns into a sizable 3-wave retracement of the entirety of the post-credit crisis low move. I don't think we're there yet. I don't think we have the evidence to say that Wave 5 is over of the cycle degree. Taking you off of the weekly, down to the daily chart, I've been focusing on this as a Wave 4 move. If we view Wave 4, if we view Wave 3 as completing into the November 21 high, That means that the first 3-wave swing into December and the 3-wave swing back into January highs was W and X, and we just did wave Y into the January 24th low. This view is starting, is being challenged as we speak. Yesterday, and we talked about this last week, we had 5 waves up into trendline resistance. We had a move down in A. We gave you the B wave resistance, expecting a secondary decline in C. But we've now seen an intraday move south of the 786 retracement. The 786 retracement of the January 24th through February 10th rally is the line in the sand. The markets start to push south of that level again and then break south of wave count invalidation at 42.2262, then we know the wave 4 did not complete on the 24th. So what does that mean? Does that mean we're automatically going to see the 50, 60, 80% bear market that some are calling for in the financial media? I don't think we're there yet. In fact, if we take a look at this wave 4, interestingly enough, and this is something I was discussing last night with our clients, this wave 4 can extend lower and still be valid as a 4th wave. In this instance, we have to source the wave 3 completion here into the January 4th high, which means we had some sort of an unusual 5-wave completion, and the correction, the wave 4 correction, didn't start until 2022, January 4th to be specific. That means the decline into January 24th was just the first actionary wave of the correction. That's just wave 1 of the correction. That would suggest that the February 9th, 10th area high was an X wave, and we're going to potentially break down towards 4,000 in the S&P. Now you might be thinking, that's a fairly directional 4th wave. But let me remind you something. Let me remind you of something, rather. Sorry guys, it's been a long week with the market volatility. Yes, coming off of the COVID low, the wave count has been a bit subjective. The initial breakout was met with some unusual corrections that weren't very clearly isolated. There was some overlap, and as a result, multiple valid interpretations. But what's the most basic of Elliott Wave count suggest in this case? Well, from the COVID low, we rally in what we view to be 5 waves. Notice the September 2020 high is just above this green trend line. This green trend line is the Elliott Wave channeling technique offered from the higher degree of trend, taking you back to the weekly chart. When you have a completion of a wave 2, a completion of a wave 4, you can draw a trend line from the low of 2 through the low of 4, project your parallel trend line over the top of wave 3. That is often where you meet wave 5 resistance. Off of the weekly, back down to the daily, you'll notice that we did see resistance demonstrated at the upper boundaries of that Elliott trend channel. But what did it actually deliver? It delivers a sideways flat consolidation. This is the largest percent retracement move that we have seen, or we had seen, from the COVID low. That tells us that's wave 2 of the higher degree. From the low in October of 20, we have 1, 2, up in 3, down in 4. Wave 4 meets equality to wave 2. That suggests they are corrections of the same degree. And then 5 waves up into January. So in the most basic of wave counts, we have 5 up, 3 back, 5 up, which is a 3-wave move. Could we still be in for more volatility? Yes, we're going to get to that in just a second. But before we do that, let me kind of demonstrate why I feel this directional 4th is appropriate. First of all, the guideline of alternation tells us corrections of the same degree will often alternate their characteristics or their corrective pattern. In this instance, if this count is valid, they've kind of flipped positions. Generally, in the wave 2 position, you have the more directional looking zigzag correction, and typically in the wave 4 position, you'll get the flat or the sideways triangle or complex. In this particular instance, we see the wave 2 being a flat, and in this case, we're now met with a directional wave 4. So that's appropriate, and that's positive alternation. Interestingly enough, we saw that same alternation demonstrated in orange wave 3. If you zoom in here to this move, you can technically count this as a flat. You got about an 85 to 88% retracement. If you look at the EWP book, they're going to suggest 90%, but in real world wave counting, there's often instances where flats unfold south of a 90% B wave retracement. even if we call this a zigzag, it's a more, the B wave had a more significant retracement. Therefore, the characteristics of the pullback into October of 21 looks more directional. You have a move down in A, big retracement in B, break lower in C. In this wave 4, we have a more directional zigzag. In the higher degree wave 2, we have what appears to be a flat. In this wave 4, we have a directional wave 4. And we're now up against another directional wave 4. So for now, we can't yet discount the idea that the correction was over on the 24th. We need to break under wave count invalidation at 42.2262. Next best case scenario, orange wave 4 is more directional. We perhaps backtest this trend channel resistance, which was offered back here. We meet the 38% retracement at 41.37, maybe go down to 4,000, which would be a quality of Y and W. And then I do think the markets have the possibility of rallying north of 5,000 before we see the larger correction unfold. Now, before I move on, I want to point out one thing. We're trading in a higher degree fifth wave. What do we know about fifth waves? Fifth waves, like wave 1 positions, can be motive impulsive or motive diagonal. Wave 5 would be an ending diagonal. What do we know about ending diagonals? 1, 3, and 5 subdivisions are 3 waves, which means the discussion I just had in regards to this being 5 up, 3 back, and 5 up could technically be, and let me take you to the daily, this is the worst case scenario view, in my opinion, at this point. That 3-wave move could technically be wave 1 of a wave 5 ending diagonal. How do we know this is the case? When and where will we know that we could potentially crack down south of 3,800, south of 3,600, maybe even visit 3,000 in the S&P? The only way we will know this is once we see, first of all, the break under 42.22. If we get the break under 42.22, best case scenario, we're going to 4,000 to 4,100. If we don't hold that 4,000 to 4,100 zone, and we see a more significant decline that maybe takes you south of equality, that's when you're going to need to analyze the bounce and look for a potential counter trend move. If we get a counter trend move there, then we could be up against a 5-wave decline, which would be A of wave 2 of a larger wave 5 ending diagonal. This is worst case back of the pocket scenario. Don't think we're here yet. We're going to continue to track both possibilities. But really the decision points are first, under 42.22. Second, you need to analyze support into this zone. If that zone of support fails and you see the 1618 secondary decline, then we could be up against a more impulsive move. Okay? Question came in regards to the Russell 2000. The Russell 2000 is a bit tricky. I would take my cues at this point from the S&P. It's still valid to be a wave 4 is here as well. There's still ways we can extend it. The biggest challenge at this point to the bullish view is the NASDAQ. The NASDAQ 100 had an intraday move under its January 24th low. Still valid as wave 4, I might add, and we're going to continue to track it as wave 4, given the fact that our wave 5 upside fib levels still support a sizable move in the NASDAQ. Okay, so that's it. I've taken enough time. I've gone well over, given the fact Alex wasn't here. Let's jump back over to the team. What are you thinking, Terry?
Bennett.
Sir.
I love your passion and enthusiasm for this. Guys, you just got the best Elliott Wave analysis of the S&P ever. Okay? This is the type of quality analysis that we provide our subscribers daily. Okay, you're getting a taste of it here on these Wednesday live streams. You're just getting the tip of the iceberg of what we offer our clients. So we really encourage you guys to seriously think about joining our subscriber service. You'll get daily inputs. You get access to the team through a private Discord server where we can exchange ideas daily, and you can get instantaneous results. Bennett, excellent analysis on the alternatives. The only thing I would say in this final wave 5 is the timing of it. Okay, I think there's an opportunity for that wave 5 to extend further in time, but it could fall out earlier if the Fed, I think, gets trigger happy, and once they start jacking the interest rates up, they don't stop and wait for the market. Okay, Alan Greenspan made this mistake, in my opinion, back in 2000. He just kept pushing the button because he didn't see anything happen, and he didn't wait long enough for the market to actually stop and absorb the moves that he put in, and then he crashed the market in March of 2000. And then guess what? They had to push the button again a whole bunch of times to jack the interest rates rapidly back down. I'm just hopeful that the Fed is going to learn their lesson from the past and not listen to everybody that keeps telling them, oh, we need to go ahead and do the 0.5% right now, or hell, let's just do 1% and be done with it. And, you know, a heavy hammer could really derail the market. So whether the Fed is actually concerned about what the S&P market is doing, I don't think that's their primary intention, but I do think they don't want to derail the entire economy, and the economy does kind of strive on what the overall markets do. So certainly, I love the analysis, guys. You're going to get a lot more if you come and join us daily on this. All right, Bennett, I'm ready to talk about rotations, because this is a time where we're transitioning. There's some different sectors in the lead right now than are typically in the lead. We need to know what those are.
Sounds good, Terry. I appreciate it. Yeah, with the Fed coming up and the unknown there, I think it is certainly worth exploring the multiple ways in which that fifth wave could unfold. So appreciate it. Let's jump into sector focus, and we will be back on the other side. Catch you guys in a few.
All right. Hello, traders. I'm Terry Long at tradinganalysis.com with your weekly sector focus. Now, the U.S. markets were closed on Monday for Washington's birthday or President's Day, whichever you call it. So we have an abbreviated trading week ahead. Now, first, let's look at last week's market performance. Last week, both the S&P and the index closed on a downward trend, looking to retest those January lows. And for the week, the S&P was down 1.58%, while the index declined 1.71%. Now, last week, the staples sector was the only sector holding on to positive returns. It was up 1.04%. while the remaining 10 sectors shared in a broad-based market decline, and leading to the downside with 2% or greater losses were the healthcare, financial, communications, and energy sectors. Now, both indexes are now trading below this red line, which is the 200-day simple moving average. The NDX is actually rapidly approaching a death cross, which would occur when the 50-day crosses the 200 to the downside. I want to point something out interesting I saw here. Was this daily candle of the NDX yesterday looks to me like a doji. It does have a kind of long spike wick up to the top and the bottom, and sometimes these guys represent reversal signals. Now, that same pattern is not quite as clear here in the S&P, and indeed in the S&P, yesterday's close was a new close below the January 27th low. So we definitely have market under pressure here. Now let's take a look at current activity here. And with the Russian occupation of eastern Ukraine in progress, the markets did swoon on Tuesday. The S&P first rallied all the way to a high of 43.62 in the first hour of trading, and then fell to an intraday low of 42.67 by 2 p.m. Eastern, from where then it retraced back higher to close on the day for 43.0476. So not quite a doji, but it certainly was an up and down day. Net daily loss yesterday, 1.01%. The NDX retraced a similar pattern, again with more clear doji here, ending down 0.99% settling at 13,870.53. Now across the board, you can see here all sectors were in the red yesterday. Let's pull this over here. There's my little thing. Looks like this morning action we're getting some positive return, but this is yesterday's action here. Everything was red, with utilities and healthcare being really the most stable, with the lowest declines, down 0.11 and 0.18 respectively. Energy ended the day down 1.53%. The consumer discretionary sector was the day's biggest loser, down 2.9%. All right, let's switch over here real quick in the sector leader scoreboard, where we use the relative strength ratio to sort our list here. Look at this. We're sitting at a 112.8 on the energy sector. This is an extreme relative strength ratio. You can see it continues to push to the right as oil remains above $90 a barrel. The staples sector also continues to add relative strength gains. You can see, but it did make a little bit of a turn there to the south. That indicates a little bit of momentum shift. Here we also have the utilities, the financials, the healthcare, and the materials sector still in the leading quadrant, with the financial sector actually showing us a northeasterly vector and continuing to accelerate higher into the leading quadrant. Also, the healthcare sector, this is the most recent one. If I'm going to animate this and pull it back to last Friday's close, last Friday we saw the healthcare sector make its move over into the leading quadrant. Now, I'll say yesterday's price action in the healthcare sector looks to have caused a reversal here, and we are now getting a momentum drawdown. The materials sector has been seeing a momentum decline, and the real estate sector exited the leading quadrant, is pushing through a very short area here of the weakening quadrant, and may likely enter the lagging quadrant here very soon. The technology sector has been pushing down into the weakening quadrant. The technology sector's momentum decline looks to be stalling, and we are turning over here, potentially the beginning of a hook, but not quite. The consumer discretionary sector pushed deep down, has made an entry into the lagging quadrant, but you can now start to see here that you've got the beginning indication of a pending hook reversal. And again, it's not yet fully formed, and I don't call them fully formed until I get a reversal back to the northeast. Now over here in the improving quadrant, we're continuing to see very slow progression to the right. The industrial sector only declined 1% last week versus the S&P's loss of 1.58. So it does continue to make a slow relative strength gains, a slow progression to the right. And then way over here in the lagging quadrant, we actually see the communication sector has penetrated up into the improving quadrant on this last couple of ticks here. You can see that the communication sector has been moving northerly with rising momentum, and actually did make a little bit of a turn back to the right. Now, one thing I want to focus on, Bennett gave us a good coverage here of what was happening at gold. Excuse me while I itch my nose. The gold, if we have completed this triangle, and then we've got this E wave complete back here, and Bennett showed you now we're going to be looking at a 1-2, and we're a progression up in 3-4. So for the now, I'm actually still kind of suspicious, because gold is actually hovering right here below 1900, and I really only had an intraday wick that kind of penetrated up above that resistance level. So yeah, to me, it's kind of like decision day. If I get a solid pop and a close above this, then yeah, I'm full on with the bulls. You can see over here in the weekly RRG chart, this is the gold miners, and to me, it looks like the gold rush of 22 is on. So guys, it might be time to start putting on your gold miner positions. If you haven't already been chipping away at it over the last few weeks, pardon my pun, I thought it was funny. Gold is challenging that last major resistance levels, and so either we see that sharp decline or we get the clear breakout. Just many of these gold miner stocks last week rallied in double digits, and this week not quite so much. Hecla Mining is up 8.8% just on yesterday, and looks like the market just opened, so I'm starting to see some change. A little bit of pullback. These 1 or 2% pullbacks are coming off of 10 and 15% moves that they made last week. So I'm getting starting to get pretty excited about the gold trade, Bennett. That's all I've got. I'll send it back to you now.
Much appreciated. Thank you so much, as always, Terry. In regards to that crude, or excuse me, the gold spike that you mentioned, it was just a brief intraday move above the B wave high in the triangle. You bring up an excellent point, because with a barrier triangle, we typically do have a flat top or flat bottom, and until we really break above that zone, we can't yet dismiss the idea that that was just a fake out move. But based on what he's seeing there in the weekly RRG, a very solid grouping does support the idea that we are working on that first motive wave. So,
right, very possible.
All right, good stuff. Hey, we appreciate you guys taking time out of your mornings to join us. Members, we'll see you in about 28 minutes for the member webinar. Alex will be back with us same time, same place next week. You can always check him out tomorrow morning, 9 a.m. for Crypto Lab here on the Trading Analysis YouTube channel. Taking a look at Bitcoin. Triangle, flat. I'm looking at the triangle, possibly a flat. I think the flat's still possible. I don't want to discount it just yet. So, hey, join him tomorrow. Subscribe with notifications if you do enjoy the content. Check us out anytime, tradinganalysis.com. Appreciate you being here. We'll see you guys next week. Terry, excellent work. I'll catch you in a few minutes. All right, take care, viewers.
Thanks guys for joining us. See you later.
Take care.